Hi everyone, it's Michelle Schneider, Mish, Director of Trading Education Research at MarketGauge and Managing Director of the MarketGauge Group, along with one of my really dear friends, Granny Retail. Earlier this week, I did a video for you featuring her husband, Grandpa Russell 2000, and how important he was as the granddaddy of the economic modern family, simply because he represented really the supply side in industrials and manufacturing as far as what's happening in the economy, in how things are moving within the United States in not only that area, but other areas as well. Remember, we also looked at Frontline, which is his dog, and actually was a stock that's been relatively outperforming. This today is Granny Retail, and we use XRT, the ETF, which I'll explain when I look at the chart of why we've chosen that particular ETF to represent what's probably the other most important aspect, or we could call it the demand side or the consumerism, which is 70% of the gross domestic product. Now, Granny and I are both wearing pink today, you may notice, because she is so important to the U.S. economy. 70% of the gross domestic product is what consumers make up. So it's really important right now, especially as we're in this situation with the market where we bottomed in July, we saw a top later on in August, and now here we are sitting currently at about 50% from top to bottom, trying to figure out what's next direction, with Granny really going to be a big influence in terms of how much inflation is going to impact the consumer, which thus far has held up amazingly well, all things considered. Now, the reason why she's a little old granny here is because she has been buying since the beginning of her life. First, she was a little girl excited about getting a new outfit for school along with school supplies, grew into an adolescent where she really wanted to be fashionable and hang out with her friends, then more into her own family life where she had children and was constantly buying things for the kids, toys and other things, clothes, etc. And also then became later on a grandma, where not only does she continue to buy for her grandchildren, but she loves to walk around the mall with her friends, because not only is it a great way to get exercise, but shopping just makes her feel good. And again, that's why the consumer is so important to the economy. Now, her cane that she has here holds her up, but it's amazing because when she walks into a store, all of a sudden she walks like she doesn't need the help of a cane at all. And that's really what shopping does for all of us. Not only does it help the economy, but it really keeps that adrenaline flowing. So next, what I'd like to do is, rather than have her talk to you herself, we're going to look at the chart together and we're going to do some analysis on XRT, where I will then explain to you about that particular basket and why we've chosen that one compared to some of the other ETFs that also represent the retail space. Say goodbye, Granny. Bye-bye. So here you see the chart of XRT. So let me tell you a little bit about XRT as an ETF. It's called a Consumer Discretionary ETF. Its benchmark index is the S&P Retail Select. It was conceived in 2006, and it has assets under management of around 257 million. The number of retail holdings is about 89, and 87.9% of it is consumer discretionary, while 12.1% is consumer staples. Many of the holdings are related to not just retail, but also technology retail, drug retail, etc. So it's a very good encompassing ETF to look at to really gauge the sentiment of the consumer. Its top holdings, interestingly enough, are Chewy, Grocery Outlook, Ollie's Bargain, Rite Aid, Dollar General, AutoZone, O'Reilly, Costco. So this is a really good place to look at for not just the consumer discretionary, but also really what's happening in the staple space. And we've talked a lot about things like Costco and O'Reilly and AutoZone as good potential plays, particularly in recessionary times. Now, looking at the chart here, you can see that just like the indices and IWM in particular, we went from having a low put in here in June, just as we were entering July, cleared the 50-day moving average in July, although didn't have quite as good time as IWM did in that it couldn't stay up there, came back through it again at the end of July when it was clear that we were getting a rally in the rest of the market. and then of course reached its peak just like everything else did in the middle of August, and now of course is sold off with the rest of the market. So what we can see here is a couple of interesting things. Is number one, this is a Bollinger Band here, as is this dotted line, and we are now below both Bollinger Bands. However, the lower Bollinger Band is creeping up, and we also have the blue line as the 50-day moving average. The green line is the 200-day moving average. So the fact that it's been selling off, again, it's about 50% from top to bottom. I would say 66 really is going to be our bottom line place that we want to see hold. Now, if we go down to our real motion indicator here, we can see that we had a mean reversion, not just in price when we broke down under this Bollinger Band, but also under the Bollinger Band here on the mean reversion indicator, which is really part of our real motion proprietary indicator. And now we're heading down to support here, just like we are on price at the 200-day moving average. If we go down here to look at the leadership or how it's trading against the benchmark, it is underperforming here, the SPY, which could be somewhat concerning as we go forward. So essentially what we really want to see here is a couple of things. One is obviously the 66 to hold, and two would be a return maybe back over 68.20, 68.50, and that would show that there's some confidence back in the market. And obviously, if the consumers are participating, then we can assume that that's going to be good for the overall market. There's also a couple of other ones you can look at, but the one that I would say, although this is not in the United States directly, this is also related to companies globally, but this is iBuy, which is the online retail space. The reason why this isn't our granny retail is because this is not in the United States directly. 100% of everything that's in the XRT basket actually trades within the United States. So the conclusion here is very simply this. You probably want to see this hold up over the 50-day moving average. This is also underperforming, also had a mean reversion here, at least in momentum. But if you're going back to the XRT as really the grandma, as we've talked about, along with IWM that we talked about, which currently is holding 190, if this continues to hold 66, if Grandpa continues to hold 190, then we know that the matriarch and the patriarch of the U.S. economy and the stock market is doing pretty good. On the flip side, if they break down under those levels, they're telling a story, and they're telling the story that eventually they're going to fold to the pressure of inflation and the higher interest rates. Thanks so much for watching, and bye for now.